Hello. Today I'm talking a little bit about monetary policy. And monetary policy in the U.S. and through many countries of the world is carried out by a central bank. And in this situation, or in the U.S.'s case, the central bank is called the Federal Reserve Board, and its current head is Janet Yellen. She was recently installed and took the place of Ben Bernanke, who had been in that position for several years. Janet Yellen, incidentally, is an economist from Cal Berkeley, and she's the only central banker in the world who's a woman. So it's quite an important position and quite a distinction that she's the first woman to have achieved that title. What's the central bank try to do? Well, in the United States, the Federal Reserve Board has been around for a little bit over 100 years. Its formal anniversary, 100-year anniversary, was just last year. It was created in 1913, and it's been around trying to protect the money supply from inflation and to provide an interest rate environment that will stimulate growth and high employment, sorry. And that's the purpose of the Federal Reserve Board. Now, how does it do what it needs to do? Well, as in fiscal policy, it first of all needs to identify whether the economy needs to be stimulated, and then it has to decide what tools it has to provide that stimulus. Conversely, if the Federal Reserve Board decides that the economy of the U.S. doesn't need to be stimulated, in fact, it might be operating ideally, or it might be even overperforming, in which case we'd have to put on the brakes a little bit. How do they do that? Well, as I said with fiscal policy, they find the target rate of, or the natural rate of unemployment, which is about 5%, and they're shooting for an output level consistent with full employment, which is operating at that natural rate. What tools does the Federal Reserve Board have at its disposal to conduct monetary policy? Well, the basic thing that they can do is they can increase the money supply, or they can decrease the money supply. They're the ones who have ultimate control over the size of the currency. And if you look closely at a dollar bill, you'll see that it says Federal Reserve Note on the top of it, and they're the agency that controls the money supply, and ultimately through the money supply, they're the ones that influence market interest rates. So if the Federal Reserve Board thinks that the economy is underperforming, then it's going to increase the monetary base, which ultimately increases the money supply, or at least in most cases it does. When the money supply goes up, interest rates tend to fall, and when interest rates tend to fall, businesses and households tend to invest more, and they tend to spend more on consumer durable goods, and those two activities provide a stimulus for the economy. So that's kind of the broad overview of what the Federal Reserve Board does. Now let's be just a bit more technical about it. Remember back to that equation, C plus I plus G plus X net, and that of course equals gross domestic product. The Federal Reserve Board can try to change consumption level spending if it wants. And again, consumer durables are somewhat sensitive to interest rates. And what's a consumer durable? Well, that's something that generally lasts a long time, like a car, like a computer, like a piece of furniture. And many times those things are bought on credit. If you go buy a new refrigerator, oftentimes you put it on a credit card, or you take out a small personal loan to finance that. Similarly, if you buy a new car, it's not uncommon to take out a personal loan to do that. So when interest rates are low, people are more inclined to buy consumer durables. They're more inclined to borrow for those. And so the Federal Reserve Board can increase those purchases of consumer durables by lowering interest rates. And again, the way that it lowers market interest rates is it creates money. And metaphorically, we can talk about them printing money. That's not technically quite how it works, but that's a good way to think about it. When they print money, there's more money in circulation, and that means that interest rates tend to fall and consumer durables tend to be promoted that way. Secondly, investment spending. Investment spending is on business, plant, and equipment, and it's also on owner-occupied housing. So if you buy a brand new house, that's considered to be an investment. If you're a firm that expands its IT or expands a conveyor belt or some other piece of production machinery, then that's considered to be business investment too. How can business investment be changed through monetary policy? Well, again, through the interest rate. The interest rate is that linkage between business spending and the interest rate, between business spending and the money supply. So if the money supply goes up, the interest rate goes down. That makes it more advantageous for businesses to invest, and they take advantage of those low interest rates and increase business investment. So those are the two key ways that monetary policy can influence business activity. Now, a couple cautions about monetary policy and how it operates. The first thing is, of course, we have to watch for inflation. The goal of the Federal Reserve is really to make sure the money supply is protected and the value of the currency is protected. And many economists would argue with this, but a secondary goal is also to stimulate economic activity. But I think a bigger goal, most economists would agree, is to protect the currency and make sure inflation does not become a problem. So one of the things the Fed has to worry about is if they print too much money with the intent of lowering interest rates, then they might have an inflation problem on their hand, and that's going to devalue the currency and create some problems down the road. A second caution about monetary policy is it has to be consistent with fiscal policy. So, for example, if the Congress is stimulating the economy and trying to lower unemployment by maybe reworking the interstate highway system and investing in an upgrade in that system, then the Federal Reserve Board has to be consistent with that, or it works much better if the Fed is consistent with that. Namely, if the fiscal policy is applying stimulus, it's a good idea if the monetary policy applies stimulus too. So both of those decision makers are working towards the same goal. Now, since the Federal Reserve Board is independent from the Congress, it's sometimes hard for them to coordinate. They have different ways of doing business. They have different constituencies, and not always are those two agencies perfectly aligned. Another thing that the Federal Reserve Board has to think about is how long it takes to get its decisions on the ground, to get its decisions actually making a difference. And this is where the Federal Reserve Board has a great advantage over Congress in fiscal policy. The truth is that monetary policy works very quickly. The Federal Reserve Board meets often, they make decisions often, they can change the monetary base quite often, and for that reason, they oftentimes are able to get their policies going a little bit more quickly than the political cycle can. A final little caution is about what economists call the asymmetry of monetary policy. And what that means is that it works better slowing the economy down than it does speeding it up. And the metaphor that they often use is you can't push a string. And if you can imagine trying to push a string, that's not a very good way to do it. It doesn't seem to work very well. And so oftentimes the Federal Reserve Board will lower interest rates, but businesses and households don't respond to that. And in the Great Recession of 2007 through 2009, we saw that problem. Namely, that interest rates were incredibly low by historical standards, but still businesses were disinclined to invest and households were not particularly inclined to want to go spend. So sometimes the thing that they're manipulating, that is the interest rate, is not always trustworthy in terms of getting the results that they want. So as we're thinking, just to summarize here, as we're thinking about what the Federal Reserve Board does and what it should do, the main thing it should do is it should protect the currency, make sure that people trust the U.S. dollar and think of it as something valuable and not prone to great bouts of inflation, as has happened in so many countries of the world. And then beyond that, the second thing that the Federal Reserve Board needs to do is think how it can stimulate the economy without creating inflationary burden.